delving into stocks, property, bonds, economics, and more. This is the Stock Market Mentor podcast. Taking an unconventional stance, we challenge the industry to help you protect your investments and empower you with the knowledge to become a savvy investor. We don't provide financial advice. Here's Steve Moriarty, Tom Hill, and Jacob Sr.
Welcome back to the Stock Market Mentor podcast. I'm Tom Hill. I'm here with Jacob Sr. and Steve Moriarty. What we're going to be covering off this week is how to think about investing more broadly. But before we go into that, I just thought we'd briefly touch on last week where we went through the 10 financial fibs. And, this whole series, we're going to have an emphasis on what not to do. And as a result, hopefully everyone, all the listeners, will actually improve their performance, or at the very least, they'll know the right questions to ask when they're dealing with their financial advisors. Yeah. We touched on kind of the three categories that all these things fall under, where we've got time. So we gave the example of, where you start is critical. So if you had invested in 2007, you'd be up about 150% today. Whereas if you'd put your money in 2009, you'd be up closer to 500%. So breaking down that myth of time in the market versus timing the market. Yep. The next thing is incentives as well. So understanding the motivations behind the financial advisors. Now, we're not sitting here calling them crooks, but, these guys have to earn a living.
Well, you're not.
I'm not. But look, when you think about it, right, if I'm a real estate agent and someone comes to me and goes, I want you to sell my house, I'm not going to say, mate, terrible time to sell.
Yeah.
Hold on to it for 12 months, then give me a call.
Yeah.
All right, you're going to go, look, makes sense to me. Let's do it. And then when you're talking to the buyer, you're going to say, never been a better time to buy. All right, and that's just how it is. And then we've got theory as well. So, look, I'll throw over to Steve to kind of kick us off on how to think of investing holistically.
Yeah, sure. Thanks, Tom. Look, it's important basically when you start out, and again, just a reminder that what we're talking to you about is all of the problems and issues that, the three of us experienced when we were beginners or intermediate investors. And so the first one is really what we want to do is talk to you about how you should think about investing. And a lot of the time what you see is you're really speculating. And what I mean by that is just give you a little bit of a difference. Investing is fairly sort of quantitative, and it basically lets the numbers dominate. You can do some numbers on an investment property or a stock and a dividend and a capital return, and that you can look at it and say that's an investment. Let me give you an idea of speculation. If you buy a residential property where the repayment is $1,000 a week and the rent is $500 a week, that is a speculation because what you're doing is relying on the capital portion or the capital gain to make you the money. And so it's a very high risk strategy, and it's not really what we say is investing. It's actually speculating. And so you need to first work out how you do that. And so that comes to, the first thing we always talk about, which is risk, right? What's the risk of losing my money? Not necessarily, my God, in 10 years, this property is going to double and I'm going to be a millionaire living in the Bahamas type of stuff. Yeah. So the first thing you've got to remember is when, it's that trade-off between risk and return. And what you're looking at is, first of all, a range of alternatives. There's bonds, there's stocks, there's residential property, there's all sorts of investment that you can take. But you have to weigh them up against the risk and the return. So, for example, if you buy bonds, you might get a 4% return, or if you do a term deposit, right, you might get 3%. But what they're saying is at the end of that period, you will definitely get your money back. Mm. Now, you're not going to kick it out of the ballpark, but we guarantee you if you come back in December, we'll give you your $100 back and you'll have earned $4. Yeah. Okay, so that's really safe. Now, that's the base that everyone uses in the industry as the sort of the riskless investment, if I can put it, risk-free. So the next step is then saying, okay, well, I'm hoping for more than that. How do I get it? Mm-hmm. You then go into something such as a residential property or a building or, whatever investment, or you buy stocks, and you have to then break that down and say, well, I know with a bond I'm going to get 4%. So that's easy, right? There's no capital gain. I get 4%, that's my dividend, and there I go. When it comes to, for example, a property or stocks, there's two facets to it. There's the dividend yield or the rental yield. Then there's the capital appreciation of the stock price or the capital appreciation of the property, right? And that's when you have to get into a little bit of the nitty-gritty. But even just working through those numbers makes it really clear that some things are investing and some things are speculating.
Yeah.
So if you buy Woolworths that has a dividend yield of 6%, and we're not recommending Woolies, but if you do that, you say, well, I know I'm going to get 6%, and look, I've looked at Woolworths and it grows about 3%, stock price per year. Okay, I'm going to end up getting around 9%. If you buy a junior mining stock that doesn't pay a dividend, then what you're doing is saying, I'm buying this stock for 10 cents and I'm not getting any dividend, but I reckon it might be worth 20 or 25.
Yeah,
now,
purely looking at the capital gains.
Yeah. There's nothing wrong with that, but you've just got to be realistic in saying, okay, well, how sure am I that the capital gains going to deliver?
Yeah.
And a lot of people don't go through that simple exercise of what they call the expected return to try and do that simple sort of stuff.
Yeah, I think the topic in general is incredibly interesting, and I just go back to 7 or 8 years ago when I first started looking at investing in general and thinking, damn, what questions should I have asked myself on this topic to begin with?
Yeah.
Because it relates directly with the old Joneses theory and all my friends making money in mining stocks and gold stocks and whatever else.
And it looks easy.
And it looks incredibly easy. And the reality is they've got no bloody idea either. But they just got pretty lucky and right place, the right time, and the industry's booming. But just thinking it might be a question to ask ourselves, and maybe even let the audience know now, like, what questions should we have asked ourselves when we initially first started? Because I can almost guarantee there'll be listeners here wanting to get into investing going, I've got no idea, but I just know a bunch of friends that have made money in crypto or they've bought a house and the property market's been booming for the last 25 years. So why can't I? So, Tom, what do you think? What questions would you have asked yourself to begin with?
Well, you got to kind of figure out what kind of investor you are. And Steve touched on it pretty nicely. For the better part of the last 20 years, being a speculator's got you paid.
Yeah.
Like, capital growth has gone absolutely
if you held your nerve,
across
You've been killing it.
Yeah, like, doesn't matter if you've been in stocks, property, metals, like, most things have done really, really well. So it's kind of it's hard for a lot of people to realize, has this been luck or has this been skill? And I think a lot of people are going to think that it's been skill. I think one of the biggest things that I struggled with when I started is grasping the fact that profits aren't profits till you've locked them in.
Yeah.
So, if I buy $1,000 worth of a stock today, and this was probably the best example. The first investment I ever made, I put $1,000 in. By the end of the week, I'd doubled my money. By the end of the next month, I had tripled my initial investment. And all I was thinking about was, when this gets to 50,000 or when this gets to 100,000, not one part of me goes, okay, you're up 350%. Yeah. Maybe take some, at least take your initial investment back and play with house money. That was not even that thought was non-existent.
You were going to be a millionaire in a year.
Yeah. I was just thinking oh my gosh, like, it's grown this quickly. In a year's time, it's going to be fantastic. I'm a genius. Sure enough, today, I think it's worth about $60.
He's still holding it just in case.
Yeah, well, it's a lesson. It's a reminder.
Yeah.
And, I did that more times than I care to admit. It took me a long time to learn how to take profits. And it all kind of comes back to when I started, I didn't realize how important it was to have a system.
Have a plan, yeah.
And, at the end of the day, like, what is a system? Like, if you've never done this before, like, where do you begin? So hopefully, you know, when we start to work through how to think about investing holistically, you start to join those dots. And, you know, throughout the series, we'll give you some ideas on how you can scale in and scale out. But, yeah, the whole objective of this, right, is...
Look, let's give us a simple approach. The first thing you got to remember is, and it's often not thought about, is the price of the asset. So every asset, every stock or every residential property or every commercial building is owned by somebody. So if there's a company with 100 shares, there are, you know, let's say everyone owns one share. There are 100 people that own a piece of that company. Now, the next step is saying, what price did they buy that company at? Okay, because the big difference here, and what I'm trying to get across to people at the moment is, particularly in residential property, is the yield is based on what you pay for the stock, what you pay for the property. So, for example, if you buy a property for $1 million and let's make it simple, the rent's, $100,000, you go, okay, well, that's a 10% yield. Okay. But if you pay $2 million for that income stream, that's only a 5% yield. If you pay $500,000 for that $100,000, that's a 20% income stream. So what you've got to do is, first of all, look at the price and relate it back to the earnings. And so that's where, you get into sort of messy things like discounted cash flow, but simply saying, well, I'm going to pay X for this. And then you break off into those two streams of saying, okay, what's the rent that I can charge for it, or what's the dividend yield, right? And then you can look at the other part, which is the capital gain part. Okay, so saying, well, what you find with all types of investing is this idea of momentum that keeps it going forward. So what you see is people say, I bought this stock at $1. It pays a 5% dividend, but it was 70 cents and now it's $1. It's obviously going to go to $2, right? And even if you said, okay, well, over what time frame? 5 years, it's going to double. You go, okay, well, that's 14% compound per year. Is that realistic? And if you look at it, you can sort of work back and go, actually, if you look at a thing called base rates, which is the long-term average, so if you look at it for things such as a rental yield, rents go up about 3 or 4% over the long term. Now, people will chime in and go, oh, Steve, they're going 15, 20%. I understand that, but it's not going to go. You wouldn't dare buy a property saying, yeah, but I'm just going to increase the rent 20% per year for the next 10 years. It's like, dude, that's not going to happen, right? But that's generally what takes place. And it takes place on two fronts. First of all, the rental yield. So rather than saying, I'm buying a property for $1 million, it's yielding 1 or 2%, which is terrible for a start, because if I said to you, well, hang on, Jacob, you can get 3 or 3.5 in bonds with zero risk. Why are you settling for 2%? Now, you come back to me and say, yeah, but Steve, this property is going to be worth, a lot more than $1 million.
Gains, yeah.
Right? That's where I can say, all right, well, throw a number at me. What do you think? Now, you can come back with a number of, say, Steve, property doubles every 7 years or 10 years, right? But I can say to you, all right, well, let's look at history and see if that's actually true. And we can go, oh, yeah, okay. There are periods there where you're right, Jacob. But, Jacob, they all started when the rental yield was 7%, not 2%. 7% means you're paying a low price for that yield. 2% means you're paying a high price for that yield. And so, I'm sorry, I'm flipping between asset classes here, but if you think about stocks, you look at the dividend yield of the ASX. If it's at 2%, and historically it's 5%, what that says is you are paying more for that yield, which means it's probably overvalued according to history. But if you buy, like Tom said before, in 2009 or even, late 2008, when it's yielding 8 or 9%, that's when you say, well, that's actually pretty cheap. That's when you can sort of say, well, I can calculate a bit of a capital gain. Whereas a lot of the time what people do is, and I'm seeing this a lot at the moment, is people are investing, I shouldn't even say that, they're speculating on the capital gain, right? And that's a really, really risky business. Now, can you make money out of it? Absolutely. And there are plenty of people that have done that. But behind that, what I find personally is there's not a lot of people who know exactly why they're making money.
No, they're in that euphoria stage of market cycles where it's just been going up for that many years that they can't see that everything cycles, right? And they're not asking themselves, okay, well, they're not looking at the macro picture almost, and it's been going up for 25 years. What's the, if I want to sell this property in the next 5 to 10 years, what are the odds that it's going to keep going up at this rate? And what we're starting to see now is so many people finding themselves in dire straits because the yield is so bad.
Yeah. And that's, so if you look at those, just if we flesh out this idea of base rates, which is really, really important, because when they say, Tom, you'll get 8% over the long term, that's the sort of long-term average, right? And that's what they call the base case, right? So look, Tom, knowing nothing, you're going to get 8% over the long term. And this is where it ties into the theory, right, with the efficient market stuff. If you look at such stuff as, well, what is the base rate? Then you can take a step and say, okay, the base rate is 8%. It doesn't matter if you're an idiot, just put your money in the stock market, you'll probably get around 8%, right? Now, we all know that's really about 2. We'll talk about that later. The second part is then saying, okay, but at the moment the stock market's offering me 11%. And that's because you then go, oh, well, that's probably because the price has just fallen from, in Australia's case, 2007, from 6,300 to 3,600. Now, at that point, most people are going, oh, man, I do not want to be in the stock market. It's ugly.
Terrifying.
But when you look at it, if I said to that person, listen, I tell you what, I found this bloody great deal. It's 10% compound per year. Oh, Jesus, give me some of that. Buy the stock market. Oh, no, you don't want to buy the stock market because, again...
It's gone to zero.
Well, but also too, Jacob, what they're saying is they're focused on the capital movements.
Yeah, that's it.
Right? But, dude, I'm going to give you like 8% in a dividend and say, oh, yeah, but the stock market's really dangerous. And you look at that and say, but when it offers you, if you take away some detail and go, listen, this thing's pretty safe and it's going to give you 8 to 10% over the long term, that's where you'd actually go, that sounds really great. It's only then if I said, look, it's the stock market. Oh, well, hang on, I need to have a think about that because it's fallen 50%. And so if you think about residential property and stock market with margin loans, it's easy to talk about negative gearing with residential property. And what I mean by that is saying, if I said to you, Tom, I want you to borrow $1 million and what we're going to do is we're going to buy $1 million worth of stock and the dividend yield is 1.5%. But, stock market's been red hot, mate, and I'm pretty sure it's going to keep going up, right? Listen, your yield is 1.5% and we're borrowing at 4%, right? You would look at me and go, that sounds like a really dumb idea. But if I said to you, listen, Tom, let's borrow $1 million and buy a property and, the rent will be terrible and the maintenance will be awful. But listen, it may, property prices have been rising. It might be worth 1.1, 1.2 in 5 years or whatever. Most people would go, that doesn't sound like a very good investment and it sounds like it's a really big risk. So that's where if you take off the rose-coloured glasses of the stock market's an easy way to make money or the property market's an easy way to make money or crypto's an easy way to make money or, you just buy vintage cars and they sell for double the price, once you put it in that numbers form, you can start to look at it and just purely say, well, hang on, I can get 4% in bonds. Why wouldn't I just put my money in bonds? right? Because that's the way it really works. What you get sort of suckered into again is this constant talk of residential property, right? There's daily indexes. I mean, that in itself is like a huge red flag going, dude, why are we listening to the daily movements of
property,
property
of
prices?
anything actually?
Yeah, exactly.
It ties into the incentives that we want to talk about as well, right? The industry want to make sure that people are constantly looking at this thing, so they're constantly buying, constantly selling, because they constantly make an income from it.
Yeah. The other thing I'd probably add as well, if you're focusing on the earnings yield and you go back and look throughout history, if you'd made your investments purely based on the yield, you would have actually done really well off the capital gain as well.
Absolutely.
As a byproduct.
Because you're buying an asset cheaply.
Correct.
Yeah. And that's your point is really important, because what we're saying is stop focusing on how much the property is going to rise. Stop focusing on this stock's going to be worth $2 in 5 years, right? You have to focus on the earnings yield, which is a mix of the dividend and capital gain. And that's a really, really important point, Tom, because in the next session we'll talk about signal versus noise. But the important point being, you hear this daily chatter about the stock market went up 0.2% today because, blah, 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 blah. Now, first of all, that means your earnings yield went from 4.05 to 4.051, right? So you're not going, holy Jesus, I better get in the market and do something, right? You get... And this is, no slide on Alan Kohler, but Alan Kohler gets on the ABC every night and talks about the stock market, right, and the daily movements. But if you look at it and say, you'd be a fool if you said, oh, Alan said the market's up, oh, I better go and buy tomorrow or, sell tomorrow. That information is actually of no benefit
There's
at all.
1 or 2 days a year max that where there might be a daily movement of 10, 15%, something incredible happens.
Yep.
And that's a signal almost, whereas the rest of it's just noise.
Yeah. And that's what we're going to go into deeper in the next session. But again, like Tom mentioned before, if you said, well, Steve, I don't know what I'm doing. How do I think about investing? The first thing to do is say, all right, what's the risk of investing your money in stocks? I don't know. Okay, well, you can get 4% in bonds. How much do you think you'll get in stocks? Oh, well, the dividend yield at the moment's 2%. Okay, that means you will need a capital growth of 2 or 3 or higher to compete with bonds or even more, because you're risking your money in the stock market, whereas in bonds you're not risking. So that's the first part. The second part is, as you mentioned, Jacob, before, separating out the rental or dividend yield and the capital gain. And it's just so seductive to get taken into the daily price movement of anything, when in actual fact it means, it basically means nothing. But people will do that because, again, the industry will report, the stock market went up today because they want you to buy or to sell or, to do something.
Excited.
Right?
Talk about it.
You imagine if there's 252 trading days a year. You imagine if 251 of those they went, nothing really happened today. Anyway, move on. Let's do the weather. Yeah. Do you know what I mean? Everybody will go, oh, right, okay, well, nothing, no need to do anything, right? But if they come on and say, today the stock market, you see that from time to time, ASX loses $55 billion in stock market rout, right? And oh my God, look at all the stocks that fell 3 or 4%. And then you come back the next day, stock market rebounds after,
0.5% because of the RBA.
Yeah. Phil Lowe said, don't worry about stocks, buy stocks. Everyone piles into stocks. So, you look at it and go, oh, hang on, 24 hours ago I was thinking I should really be thinking about getting out of stocks. Now I'm thinking, oh man, it's a really good time to get into stocks, right? And that's what I mean. You've got to put all that aside and be, dare I say it, like Warren Buffett and say, okay, let's look at the return on this asset, right, or on this investment. And what you do is, again, saying, am I investing or am I speculating? Mm-hmm. And you can have a mix of both, right? But you really just want to be honest. And the way to do that is to talk about the base rate and say, well, the long-term return is 8%. Okay, what is different about now that I expect to get more than that? Now, you can say, oh, okay, well, it's because the price is a lot lower. Okay, that's excellent. Or you can say it's because I expect a really big capital gain. Or, like you were saying before, Tom, I'm actually a stock market genius and therefore I'm going to deliver 15%, right? And if you do that, you can say, okay, what makes you think you're a genius, right? And you guys had that experience with crypto where there's a lot of talking about it. And again, it's not as if you can't make money out of it. But the question is, what's the price related to the value, right? It's you don't invest in crypto. You speculate because you don't say, why is it worth 30,000 and how come 2 years ago it was worth 65?
Exactly, yeah. I think it's important that you touch on, or that we touch on, having just a set, solidified plan as well before you get into any asset or any investment. Where do you want to get in? What's the yield giving you, and where do you want to get out, and what does the exit strategy look like? I mean, there's so many examples I could give you, but let's bring up the mining speculation for a short
excellent
amount of time.
idea.
Yeah, just because Steve will keep bringing.
Have you got an example, Jacob? A personal one,
maybe a small one. Well, look, initial investments, early days, 2015, 16 in a mining Ruby stock actually, and they were forecasting. I invested a few $1,000s. They were forecasting to pull out the world's largest rubies out of the ground that have ever been seen. Basically like moon rubies or something. I don't know. So
sounds amazing.
Of course, that a few $1,000s turned into $17,000, $18,000, $19,000 overnight, and they had this huge uproar of interest in this tiny penny stock. Anyway, so what did I do? Instead of taking money off the table and an exit strategy, I actually put more money in at the top. And I thought, let's invest more. This thing's I'm going to be a multi-squillionaire.
Put another 10 grand
So I put another $10,000 in, or whatever it was at the time. And about 3 days later, it sat around that price for a little while, and then it subsequently went more south than anything, and it ended up. It's now not worth absolutely zero because the company folded. They folded 3 or 4 times and stopped trading. So that few $1,000s and an extra 10,000, which was worth probably 30 at its peak, is now zero. So it is really important to ask yourself, when you're thinking about how or where to start investing, what's the risk, the yield that it's expected to give you, and compared to other assets, what's the macro look like? Yep. And then, most importantly, what is the exit strategy? How do you take some cash off the table? Yeah.
Well, let me just summarise. What we want to do in this podcast series too is we're often going to talk about things that you shouldn't do. But we're not going to leave you lying there going, oh, well, okay, that's great, guys, but what do I do? So we're going to summarise at the end of each podcast what you should do, or how you should think about it before you invest. And so let me tie it up here. First of all, you want to talk about whether you're investing or whether you're speculating. And the other thing is too, I'm not against speculation, but what you need to do is say, I am speculating, right? And if you do that, that should automatically make you go, okay, let's not put the house on penny stock because I'm speculating. So that's the first thing. The next step then gets into the nitty-gritty. So you say, okay, what is the base rate over your holding period? So, for example, if you say, I'm going to buy stocks for 10 years, what's the 10-year return? And we're going to talk about that a bit further because, as you guys know, it's like from 16% per year to 2% per year. Hence why we want to talk about timing the market, not time in the market. But what you're doing is saying, oh, okay, what should I expect if I'm an idiot that has no special talent? Then you can look at the current price or the dividend yield. Then you can step in, as I said, with the base rates and say, okay, what's special about now that makes me think I'll get a higher than average return? Oh, the price is really cheap historically using a CAPE ratio, using a PE ratio, using some sort of valuation metric, right? The rental yield on this property is 8%. Oh, why is that? Because the property is really cheap, okay? We're at the bottom of a property cycle. Oh, well, there you go. That's why it's a good return, okay? So, and that point demonstrates just don't look at the capital gain. Because what you often find, and this is why Warren Buffett says, if you're a long-term buyer of stocks, you want cheap prices. And for a really long time, I thought, that's a really stupid idea, like, why would someone say that? But now I know that what Buffett is saying is, look, if you want to buy stocks and they will yield you 10 or 11% per year, rule of 72, you're going to get rich, and do really well. But if you want to speculate on the capital gain, you want the stocks to go up a lot. But that won't deliver wealth over the long term.
Yeah, that's right.
Right? You've got to keep replicating that speculative behaviour. And that's where a lot of people, like we've all done, you buy a stock, it shoots to the moon, you think you're a bloody genius, and so you go and do it again, right? And you keep doing it until you go, oh, actually now I've, just blown most of my profit.
I don't actually understand this thing very well.
I'm actually not a genius.
Yeah.
So a couple of things. What's the income stream, right? As a dividend yield or the rental yield, right? As a factor of the purchase price, what can you expect as the capital gain? So there's the first way to think about it. And you look at that and say, well, can I raise the rent? And say confidently, yeah, I can raise it at 4% per year. Okay, well, I can project out, you being conservative, this is how much it's going to yield in the future, right? And you look at all the costs and blah, blah, blah. So that's the way you want to think about it. Will a company continue to pay the dividend yield? And you can look at that. You can look at a thing called the dividend ratio. Is that right? The payout ratio, sorry. And it will say BHP's paid a dividend every year for 30 years. Okay, well, I'm pretty sure I can, work on them paying a dividend, right? Then you can say, well, am I happy with 4% and, the capital gain, blah, blah, blah. So that's where you can really do it quite simply by just saying, righto, I'm no one special, so I'm just going to say what's the base case. And then if you do know what you're doing, to say, okay, what's specific about now that I want to invest? Oh, because the market's crashed. Okay, that's a good idea because now you're getting a higher earnings yield. Yeah. Right? And we'll talk more about that and the capital gain in forthcoming episodes. But generally that's the best way to think about it.
Yeah, I obviously totally agree. We've been working together for the last however many years. But
I'd be shocked if you didn't.
Yeah, no, I absolutely disagree with that. Just adding to my point before, it's important to have a plan in the first place. I think if you're listening to this and you've got no idea, start working on your investment plan, using some of the key things that we've spoken about and other things that we'll talk about in the next few episodes.
All right.
Perfect.
All good, Tom. All right. Thanks for tuning in, folks. We'll see you next time. If you've got any couple of points. First of all, nothing we say here is financial advice, so please don't go off and buy junior mining stocks or crypto. Or if you do, come and talk to Jacob. He's an expert at telling you how to lose money. Secondly, if you have any questions, please drop us a line at the website there, and we're happy to talk or answer the question as best we can. Other than that, we'll leave it there, and we'll see you all next week. Cheers, folks.
Cheers.
That's it for another episode of Stock Market Mentor. We hope you have enjoyed the show, and if you have any questions about the episode or want to discuss how we can help you become a better investor, please feel free to contact us at support@stockmarketmentor.com.au. We'll see you next time.